REITs let you invest in commercial real estate, offices, malls, without needing crores of rupees. Six REITs exist in India today, but two problems have kept people away. There's never been a REITs focused mutual fund, and REITs taxation is genuinely messy. Different income components taxed differently. Both problems just got solved. Two REITs mutual funds, India's first, have launched as NFOs, one from Edelweiss, one from WhiteOak Capital. Why now? Commercial real estate is in a genuine upcycle, and REITs just got reclassified as an equity instrument in India, which is what actually made a passive index fund like this possible to build. Let's break down both funds. The Edelweiss Nifty REITs and Realty Index Fund is passive. It tracks an index holding roughly 60% REITs and 40% realty stocks like DLF and Godrej Properties. Why the 40% in stocks at all? India only has 6 listed REITs, too few to build a diversified all REIT fund without dangerous concentration. As more REITs list, this mix is expected to keep tilting more REIT heavy over time automatically. The WhiteOak Capital Dividend Yield Fund is actively managed up to 60% REITs, up to 10% InvITs, and up to 25% in equity and arbitrage combined. Three real differences from Edelweiss. It includes InvITs, Edelweiss doesn't. REITs are now pure equity, InvITs are hybrid, so you can't cleanly mix them in one passive index. Its equity sleeve leans arbitrage heavy for stability rather than extra return, and a fund manager actively picks allocations instead of just replicating an index. NFO windows. Edelweiss runs 5th to 19th August. White Oak runs 10th to 24th August. Three sources of return here. Rent, the steady base, roughly 5 to 7% a year. Rent growth. Indian commercial leases typically have 4 to 6% built in annual escalations, plus, new tenants often pay more than the ones they replace, and price movement tied to interest rates. REITs behave like bonds here. Rates fall, REIT prices tend to rise. Rates rise, prices tend to fall. This hit hard in 2022 to 2023 when rates spiked. This third factor can completely overwhelm the calm rental income in any given year. Exactly why this is classified high risk, not an FD substitute. One structural point that trips people up. In this fund, quarterly rent doesn't land in your bank account. It stays inside the fund and compounds. Your return shows up as NAV growth, realized only when you sell. That's different from holding a REIT directly, where you'd get a payout each quarter. Here's the actual problem this solves. Hold the REITs directly, and its distributions get taxed at your income slab rate every year. A real drag if you're in a higher bracket. Real numbers from Edelweiss's own illustration. Invest 1 lakh rupees, get a 6% distribution, just 6,000 rupees. Held directly at the 30% slab, you lose 1,800 rupees in tax immediately, dropping your post-tax yield to just 4.2%. Inside the fund, that same 6,000 rupees isn't taxed at the fund level at all. It compounds and the full 6% keeps working for you. You only pay tax when you sell, and it's taxed as capital gains. 12.5% if held over 2 years, slab rate if held less. One more tax detail. A 10% TDS applies if your distributions cross 10,000 rupees in a financial year. That gap, 4.2% versus the full 6% compounding, is the entire efficiency argument for this fund. One honest caveat. Since REITs only recently got reclassified as equity, this exact tax treatment has no precedent yet. Treat it as the current expected structure, not a guarantee, and check with a tax advisor. And this benefit only pays off if you actually hold long enough for the compounding to build. This isn't a park for 3 months product. Since these are brand new NFOs, neither fund has its own track record, but the underlying Nifty REITs and Realty Index has data since 2021, and it has meaningfully outperformed the Nifty 500 over both 3 and 5-year periods, with decent downside protection despite running more volatile. On valuation, most listed REITs currently trade at a discount to their underlying asset value, a reasonable sign you're not buying at the top, though not a guarantee of a bargain either. The single most important number to track ongoing: occupancy rate. How much of the REIT's real estate is actually rented out? Every Indian REIT currently runs 90% or above, which is healthy. A slide toward 85% or 80% would be a real red flag. Quick practicals. Edelweiss's minimum investment is just 100 rupees. Expense ratio reportedly up to 0.9%, no exit load, and the fund is expected to carry a very high risk label, typical for a sector specific index fund like this. This fits someone who already has their core portfolio sorted: equity, emergency fund, insurance, and wants a small satellite exposure to real estate income. Comfortable with real volatility, specifically chasing tax efficient compounding over years. Skip it if you want a safe short term parking spot. If you want monthly income actually hitting your bank account, this compounds inside instead. Or if this would be one of your first few investments ever. This is a slice of a portfolio, not the foundation of one. Quick recap. Two new REITs mutual funds solve the real headache of REITs taxation, turning a 4.2% post tax yield into the full 6% compounding inside a mutual fund wrapper. Returns come from rent growth, and interest rate driven price swings, the volatile part. This is a satellite holding, not a core one. And the one number to keep watching is occupancy rate. Do your own due diligence before investing. If this helped, hit like and subscribe.